Hello and welcome to the Commodities Institute podcast. I'm Emily Costa and today is January 22nd, 2026. Gold has been on a remarkable run and now one of the most influential voices on Wall Street has pushed expectations even higher. Goldman Sachs has raised its end of next year gold price forecast by $500 an ounce, taking it to $5,400 per ounce. That is not a marginal tweak. That is a statement. Spot gold has already climbed to just under $4,900 an ounce, and it is up more than 11% so far this year, after rising more than 60% last year. What Goldman is really saying here is that a new base level of demand has emerged. Private sector investors and emerging market central banks are buying gold, not as a short-term trade, but as a long-term hedge against policy risk, geopolitical uncertainty and currency volatility. The assumption now is that these buyers are not going to rush for the exits in 2026. They are holding, and that raises the floor under prices. Add to that the expectation that Western exchange-traded fund holdings will start rising again as interest rates come down, and you have a powerful combination. Central banks alone are expected to buy around 60 tons of gold next year. The message is clear. Even if inflation cools and growth stabilizes, the appetite for insurance has not gone away. Gold is no longer just a crisis trade. It is becoming a structural allocation. From metals, let's pivot to power and energy security in Europe, where there is a growing sense of frustration among industry leaders. The chief executive of one of Europe's largest renewable energy companies is warning that the urgency sparked by the war in Ukraine has faded. His argument is simple and uncomfortable. Europe talks a lot about energy independence, but it is still moving far too slowly to achieve it. Permitting and licensing for wind and solar projects can take 4 to 6 years, even though the actual construction might only take a year or a year and a half. That mismatch is costing Europe money and competitiveness. Imported gas remains expensive, often several times the price paid in the United States, and that price gap feeds directly into industrial costs and household bills. And yet, there is also progress. New data shows that in 2025, wind and solar generated more electricity in the European Union than fossil fuels for the first time. Renewables now account for nearly half of the power mix. Solar alone provided 13% of electricity, expanding for the fourth year in a row. Coal's share has fallen below 10%, and many countries are now producing more power from wind and solar than from all fossil fuels combined. The contradiction is striking. Structurally, Europe is changing its power system. Politically and administratively, it is still dragging its feet. The next challenge is gas. Despite the renewable surge, gas use actually rose last year due to weak hydro output, pushing up import costs and power prices. Battery storage could help smooth that volatility, but only if deployment accelerates. The transition is real, but it is uneven, and the clock is still ticking. Now let's turn to oil, where geopolitics is once again rewriting trade flows. US refiners are buying Venezuelan crude again, this time through trading houses newly authorized under Washington's deal with Caracas. Valero and Phillips 66 have each purchased cargoes, marking the first US purchases from these traders since the change in Venezuela's political leadership earlier this month. The numbers matter here. The crude is being sold to US refiners at discounts of roughly $8.5 to $9.5 per barrel to Brent. The traders themselves reportedly bought the oil at around $15 per barrel below Brent, absorbing shipping costs of roughly $2.5 to $3.5 per barrel. That still leaves a healthy margin. This is not just about price, it is about quality and compatibility. Before sanctions, US Gulf Coast refineries processed up to 800,000 barrels per day of Venezuelan heavy crude. That capacity never disappeared, it just went unused or was filled with alternative blends. This deal reopens a familiar channel, but under very different political conditions. At the same time, supply risks are flaring elsewhere. Kazakhstan's oil exports via the Caspian Pipeline Consortium remain under pressure. Maintenance at offshore loading points is nearing completion, but a fire at the giant Tengiz field has triggered force majeure, halting production at a site that can produce close to 900,000 barrels per day. Drone attacks, Damaged infrastructure and redirected cargoes have already cut exports sharply. For a pipeline that handles about 1.5% of global oil supply, these disruptions ripple far beyond the region. Let's move into agriculture, where the contrast between grains is telling. Ukraine's wheat exports remain subdued. Attacks on ports, damaged infrastructure, and weak global demand have all taken a toll. Shipments in the first half of January were less than half what they were in the same period last November. Competition from cheaper Russian wheat is squeezing Ukraine's position in key markets. Corn, however, is a different story. Ukrainian corn exports remain strong, with shipments rising steadily through early January. Corn has become one of the most liquid and active markets for Ukrainian exporters, reflecting resilient demand and more flexible logistics. In Asia, buying interest is firm. Taiwan has just purchased around 65,000 tons of animal feed corn, likely sourced from the United States, taking advantage of lower Chicago futures following estimates of large US harvests and inventories. Jordan, meanwhile, is back in the market for wheat and barley, issuing fresh tenders that underline steady import demand in the Middle East. Russia is also rethinking its agricultural strategy. With grain exports slowing due to low prices and weather challenges, officials are now pushing companies to invest in food processing abroad. The idea is to export value, not just volume. Milling flour overseas rather than shipping raw grain could help stabilize revenues and deepen trade relationships, but it also signals an acknowledgement that the era of easy export growth may be over. As we wrap up today, what ties all these stories together is adaptation. Markets are adjusting to new political realities, new risk perceptions, and new structural trends. Gold is redefining its role. Europe's energy transition is advancing, but not fast enough. Oil flows are being redrawn by diplomacy and disruption. Agriculture is splitting between winners and laggards based on logistics, demand, and strategy. These shifts do not happen overnight, but they compound over time. And as always, they remind us that commodities are not just about supply and demand. They are about policy, psychology, and power. That's all for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.